Well, hi, and welcome to our Wednesday live stream panel discussion, the first of our Wednesday live stream panel discussions for startup founders and investors. So I'm Brett Waters. I've been in Silicon Valley my entire life, immersed in the world of entrepreneurship, innovation, and venture capital. And joining me this morning is my good friend, Louis Lowe. Morning, Louis.
Oh, muted.
You're muted, Louis.
Thanks for putting this together, Brett. It's always fun to have tacos with you, even in the morning.
Yeah. So, Louis, brief introduction on yourself.
Like you, Brett, I'm originally from the San Francisco Bay Area. So I'm a Silicon Valley lawyer, and I help startups get formed, financed, scaled for growth, and hopefully some sort of liquidity event.
So, Louis, you and I have been in the Silicon Valley startup world for a few different cycles. Louis, do you remember 2021?
Wow, it's a blur.
And more importantly, Louis, did you invest in SoftBank's pizza robot venture?
I did not.
You did not. All right, good. So you dodged a bullet on that one.
I did invest in FTX, though.
Oh, did you?
Took a bullet on that one.
Yeah, you definitely took a bullet on that one. So in 2023, it's a different world, right? There's still plenty of early stage financings going on, but the pace may be a little different, and the financing structures may be a little different, and that's what our discussion is today. So for our audience, as we go along, please type into the chat box any questions you may have for our panelists. And to start with, just type into the chat box where you're joining us from today. We'd love to know where you're joining from today. So we've got a terrific panel of experts here to discuss this topic of the early stage startup financing landscape in mid-2023. And I'll ask each of them to introduce themselves briefly. Ben, who are you and why are you here?
Hi, my name is Ben Haywood. I'm a general partner at Sky River Ventures. Sky River is a relatively new early stage pre-seed seed deep tech fund out of Boston. We are actively investing out of Fund 1. It's a pairing of myself, who's a former entrepreneur, came from the digital health world, and my partner, Shukchan Sa, who was at Samsung Ventures for most of the last decade. And we are looking for amazing technologists and entrepreneurs and really want to work on companies that are really tackling some of the harder problems in the world.
Yeah, terrific. Welcome. Natasha, tell us about you.
Hello. So I'm originally from Canada. So born and raised, worked in Canada for some time. I am currently in the East Bay, Oakland. I am similar to Louis' practice. So from inception to exit, that's pretty much how I help companies.
Inception to exit.
Inception to exit, and everything in between. In addition, I'm also the co-chair of the AI subsector at Foley, which is kind of tucked under our innovative tech sector.
Terrific. Thanks for being here. And Taylor, what are you all about?
Thanks for having us, Brett. So I'm a venture partner at Tenacity Venture Capital. We're a $60 million pre-Series A fund, investing $1 to $3 million, doing co-leading rounds into the best and brightest founders we can find. And that's a little bit about Tenacity.
Excellent. And also joining us this morning is Igor. Igor, can you hear us okay?
Yeah, I can hear you guys fine.
Awesome. Give us a brief introduction on yourself.
Yeah, thanks for having me, and sorry about the technical difficulties with the camera. We're trying to sort them out here in real time. But yeah, thanks for having me. My name is Igor Tabor. I run an early stage AI focused fund called Cortical Ventures. I tell a joke that we were investing in crypto as of like 3 weeks ago and recently pivoted to AI. That's a joke.
But is it though?
Well, I was just, anyways. We've been most me and my partner have been in the space for about 15, 20 years, having started and scaled AI company, most recently a company called DataRobot, which became one of the category leaders in enterprise AI. And Cortical, like I said, an early stage, seed and pre-seed stage fund focused exclusively around data infrastructure and AI.
Terrific. Welcome. So, Louis and Natasha, let's start with you because you guys are attorneys who handle a lot of financings, and so, kind of from your perspective, what's different about today than 2021. What should people know if they're hitting the fundraising trail today?
I would say the first thing is that investors are not moving as quickly as they did in the past. So
Yeah, the pace is
2021, essentially no diligence, like very little diligence. Now, investors are really kicking the tires. So making sure you're really locked down when it comes to, engaging or trying to get some investment, making sure your documents are in order is a key thing. And then just the volume has significantly decreased. We've seen, TechCrunch, all the different publications have been telling us that, things are down. And, just based on our volume, it's been a little lumpy, I'd say, for our practice in terms of, some months are really busy, some are slow, and it hasn't been a very, consistent run, from the gate like it was in 2021.
And Natasha, have you seen, sort of anecdotally, what I've heard is that seed stage is holding up reasonably well. It's the later stage stuff that's way off. Does that map to what you've seen or not?
That is, and I think it's, the later stage, they're waiting to make sure they can get a better valuation, right? You're not going to try to go out and guess what your valuation should be, or I think people still have the hopes that, 2021 valuations, which were through the roof, will come back someday.
Right.
So, I think people are still holding out, even just for things to kind of stabilize a bit, right? Because there was a big swing. So just trying to normalize. So I do think the later stage are trying to do things like bridge for now, right?
Right.
As opposed to going out and trying to get investments.
Well, of course, the other thing is the IPO window has been kind of shut, and that has a big impact, a much bigger impact on later stage than it does earlier stage. Right. So, Louis, is 2021 ever coming back, Louis? Should founders just kind of wait and valuations will go back to 2021 levels?
Brett, like you, I've seen a cycle or two, maybe three. And the great news about any cycle is that there's going to be another one. And I continue to think that this is the best time in the history of the world to be in the startup space and building a new business. I have the great fortune of having friends like Taylor and Ben and Igor when he pops back on, who are early stage investors, seeding fantastic companies that have big ideas. And we continue to see great companies get formed, great companies get financed, and like Natasha said, my advice is to not leave things to chance. Have your ducks in a row. It was a very prescient remark that Natasha made that investors are taking their time, they're doing some diligence, and they're easily spooked. So we try and present things in a very neat and way that allows people to go quickly and to proceed with confidence. And if I can do one thing for a startup founder, that would be it.
Perfect. Taylor, you, if I recall correctly, you raised a fund for Plug and Play and spent some time there, and then joined Tenacity and helped raise a fund there. So you've seen this, landscape for a few years now. How would you describe 2023?
Yeah, I would echo that. It's a great time in seed. There's a ton of opportunity, but diligence is definitely taking longer, or there is more time to diligence founders. So whereas previously, if it took 100 things to get to yes and one thing to get to a no, now I would say it's probably 250 things to get to yes. So you just have more time to diligence the founders, spend more time with them. There's less, there's less competition and other seed funds actively deploying. So when you find something, you can really get comfortable with the founders and spend a lot more time. Before you kind of, you got to do as much diligence as you could with the timeline that the founder was given, but now you're probably given double the amount of time, and there's you're able to negotiate, the valuations on these companies.
Right. And Ben, you're in the Boston area, which is kind of the other VC ecosystem. So what does it look like to you?
Well, yeah, like you guys, I've lived through a few cycles. I was in the Valley for Web 1.0. I built a company sort of in the Web 2.0 era. And we started this fund in 2021, so sort of peak. And, being on the other side of the table, as a venture capitalist, not as an entrepreneur, felt very off. The balance of power, so to speak, sort of felt very off in 2021. And, I think of investors and entrepreneurs as a long-term partnership, and you really need to find the right fit. And I felt like the investing, just the language and the model and everything was just broken in 2021 with, there's too much drive on the entrepreneur side and too much leverage. And so I feel like it's kind of the universe has come back in balance, and, you're having better conversations about what, fit and investor fit and valuations and some of the things that others on this call talks about. And I think that's very important for company building. And I'd also echo Louis, like, I think I can't be more bullish about the time that we're in with early stage. It's a great time to be investing. Obviously later stage is tougher with the liquidity window closed, but with an early stage, we got time for that window to open back up.
Right. So let's talk about financing structures and instruments, because I know that, we have two attorneys on the call and they like to talk about things like structures and documents and things. So there was a time when early stage startup financing was either structured as a note or it went directly to equity. And then convertible notes became the standard way of doing it, an instrument that begins as debt and then turns into equity upon some trigger. And then, which was mostly to defer the valuation question. And then a few years ago, Y Combinator came out with their SAFE, which stands for Simple Agreement for Future Equity, as a lightweight document for seed financing. And the whole idea was that it was a super lightweight, easy document without a whole lot of terms to negotiate. And then everybody started doing side letters with their safes, which made them just as complicated as any other document. So, what's going on these days? Is it all safes still? What are you seeing, Louis and Natasha?
Well, I defer to Natasha to kick us off. Natasha?
Yeah, I've been seeing a mix. So the convertible note I thought had died, and it's come back. So I've seen a mix of both safes and convertible notes. Obviously, like you said, convertible notes are super easy, right? If somebody needs a quick bridge, you throw a convertible note in place and you're good. But I have been seeing a lot more convertible notes than I've seen in the past.
And why is that, Natasha? Why have convertible notes come back? Just because people are nostalgic for them, or?
Investors can decide, right? The investors rule the day now, right? So in terms of safes, think of them, right? They have no interest, no maturity date. You kind of are beholden to the investor. Whereas now, if you can get a convertible note in front of a startup, they get interest, there's a maturity date if something doesn't happen. So there's more certainty, right?
Well, and also the debt has seniority in the liquiidity stack, right? So that's
exactly. I was going to say that. Yeah, you get your money. If something goes wrong, get your money back.
Right. Yeah, so that's interesting. You've seen a swing back toward convertible notes, and today it's a mix of convertible notes and safes. Louis, what are you seeing?
I'm seeing a lot of priced rounds. Where early stage investors are saying, hey, let's not kick the can until later. Let's set things up right for a good Series A. So let's put in the structure now to have a proper Series C preferred instrument. I'd like to take my board seat, or have you set up a board that I can take the seat, as and when needed. And really it takes you got to have the hard price discussion now, but it takes that off the table. This whole concept that you have in a safe or a convertible note of a cap, and it takes away the looming fear of, if a convertible note, what happens if you don't raise an A within the before the maturity date, and do you have to foreclose on it? So I think that it's a great time to raise a seed preferred equity round if possible. Take the time, do it right, set it up properly, and if you're an investor, you know what you're getting, and you're not having a hostile discussion with the founder in a year if they're unable to, raise the next round.
I actually had that experience once. I founded a company. We did the seed financing as convertible notes, and then 2 years came and went, and we hadn't raised an equity round. And it wasn't clear from the way the notes were written. It wasn't clear what was supposed to happen. There was no... there was nothing in the note about what happens if 2 years comes and goes and you haven't yet raised. raise an equity round.
Well, it matures, and you could be foreclosed upon.
No, I understand, but that
Yeah.
that wasn't what I wanted at that time.
Yeah.
And luckily the investors were all in tune, and we just simply agreed to convert them all to equity.
I'd love to hear from Igor, Taylor, and Ben. When a founder talks to you about the instrument, I'm sure they all start with, "Here's my safe." What do you tell them, Ben?
Yeah, I mean, I mean, our first, our preference is always to do a price round. I mean, I think, if you really are getting on the venture train, which is companies, we want to look at that are really gonna, grow very fast and potentially need a lot of capital, you may as well set up the ladder early. And I think kicking the can down the road just doesn't do anyone any good. And as an early stage investor, the uncertainty of what you're going to get just makes it much harder. I don't really, obviously as an entrepreneur, I love the safe. It seemed great, but I don't think it actually makes a ton of sense. I know it speeds things up. It keeps legal costs down. Maybe it puts you guys lowers your top line. But we really try and drive towards, price round, but we'll do all three.
One thing I'm telling founders is, they always think that the safe will convert at a higher valuation if they set the cap high and they raise the equity round later. But in this environment where valuations are challenged, that's not always the case. And so I think it's a good bargain to set the price now and know what you're getting and not have interest or maturity dates. But Taylor, what do you think? What do you say? What do you see?
Yeah, I mean, we're all about optimizing for the upside. And so we tell founders, our pitches, you're not going to have more time than now. Like a year from now, your company's presumably going to be 3 times as big. You're going to have less time to organize these docs. So you might as well have some defensible Series A type docs set up now when your company's, 10 to 12 people if it's seed, compared to a year or two from now when you're going out to raise that Series A.
Well said. Well said. What about you, Igor?
Yeah, so we're typically very early. We're like the first money into the company oftentimes, or at least the first institutional money into the company oftentimes. And quite frankly, that's not the hill we die on. Ultimately, we maybe have a slight preference for a priced round, but not enough preference to push it. And so a founder, if wants to do a safe, we do care about things like a cap, so we definitely negotiate that. Kind of other side letter type of provisions. But yeah, we don't have a strong preference on this thing. And you can see it from a founder standpoint. If you're raising $1.5 million, $2 million round, does it make sense to spend $50K out of that to do a proper deal versus having extra 2 months of engineering resource time? I mean, it's a real trade-off, and so. So yeah, we don't care, to be honest.
So it's interesting that all 3 of our investors have some flexibility on this. I think Ben and Igor, I think you both said that your preference is priced rounds, but that you got flexibility on it. And the whole valuation thing is a matter of who's taking the risk, right? And so the question is, do we think valuations are going to go up in the next couple of years or not? And and certainly in the environment of 2 years ago, it seemed like valuations were high and topping out. Today, I could certainly see where an entrepreneur would be hoping that valuations would be going up, and so they'd rather kick the can down the road. But sure, interesting.
Yeah, I don't think if you do a safe as the cap, I don't think it really doesn't.
Yeah.
Keep an evaluation down the road. I think you pretty much the same thing. You kind of decided.
Right.
The high end of what the high end of the valuation is going to be. I mean,
right.
Louis said it doesn't mean it's going to. If you want to go down from there, it can go higher than that for conversion, right? So.
Yeah.
So yeah, I don't know if that's a particular thing that matters for valuation. The instrument doesn't really matter.
And Ben, what are you looking for in a deal, and to what extent is that different today than it was in the past, or is it the same?
I mean, For us, it's the same. I mean, I don't think it's that different. I mean, I think we were pretty slow rolling out investments in 2021 because of valuations. We passed on a number of deals just straight up on price. We want to add value as investors. We don't just write a check and to a bunch of companies and hope they pop. We're really trying to add value. So, we like to get board observer generally, and, be involved and know what's going on in the company so we can do the most with our network to help them succeed. Obviously, just pretty straightforward early stage terms. I mean, there's nothing rocket science about it. I just think now the valuations, you can have the conversation, you can move it up or down a little bit from where the entrepreneur is, and it doesn't squirrel the deal automatically like it did 2 years ago.
Right. But fundamentally, what you're looking for in terms of an attractive investment, attractive opportunity, is the same today as it was 2 years ago. Yes.
Yeah, absolutely. Yeah, no, we're looking for great founders working on, with great technology, working on hard problems with huge upside.
Taylor, same for you?
I'd echo Ben's point. I mean, the bar has not changed for us. It's the same. If not, it's certainly gone higher. So that's part of the byproduct of seeing some of our companies that are crushing in the metrics needed and the valuations at the Series A. So it's actually just made the bar that much higher, I would say. But I echo Ben's point.
And Igor, how about you? Is the sweet spot deal for you the same as it was a couple of years ago? I'm not talking about valuation here. I'm just talking about the ingredients, the founder, the technology, the size of the opportunity, the differentiation, all that stuff.
Yeah, exactly. No, I don't think that part, I guess, kind of that part doesn't really change with times. It's the same thing you look for when you do an early stage investment. I will say I didn't get a chance to chime in on your very first question around valuations and rounds, but I think it's related. I do think there's like a tale of two cities in the tech space right now. Like you have like everything you guys were saying at the beginning is definitely true for like part of the tech, and then it seems like AI stuff is its own animal.
Yeah.
There's its own set of rules, and those rules probably hasn't changed, unfortunately, since like 2021 or 2022. Like seems like people haven't really learned the lesson, and it is a tale of two cities for sure. And
so basically, you think AI deals are overpriced right now? Is that what you're saying?
Yeah, there's no doubt about it.
Yeah.
That's a good time to drop in a plug. We're going to have the next installment of this series next Wednesday.
We are indeed
talking about everything that's going right and wrong in AI. So we'll double click on that specific question further, Igor. Thanks for raising that. But just to summarize, I think what I heard from Igor, Taylor, and Ben is that it's never been as great a time as now to start a new company. They're still looking for the same things, which are great founders, disruptive technology, big market opportunity, and they're flexible and they're putting capital to work in the seed stage.
Maybe one thing I'll add that the one thing that's always true, but I think it's especially true when you invest in a thing that's like that's hypey, whether it's AI or anything else. Every time you invest during a hype cycle, it's almost easy to start a company during hype, and you really want to dig into a founder as they start a company. Are they starting it because it's hot and it's easy to raise money and things like that, or are they starting a company because they really have a passion about it? And they would have started this company no matter whether AI is hot or cold or anything in between. They would have started their company anyways. I think that distinction is actually very, very important. And we try, to the degree possible, we do try to, nut it out.
Yeah.
I'm getting one question on my text because I think the chat or Q&A might not be functioning in the best way, as to what are the check sizes and what are the valuations that each of you are seeing. And I don't want to put any of our friends on the spot here, but I'll just say anecdotally that in Web3 in 2021, I saw anybody coming in and they could raise 3 on 30. That was kind of the magic formula. And
3 on 30.
3 on 30, and sometimes with some sort of token warrant. And unfortunately, I'm seeing Web3 under a whole lot of pressure right now, and I'm not seeing those kind of numbers. But I think that did translate into any kind of what I'll call a hot startup with a founder who had raised before, who had exited before. And today what I'm seeing is more like 1.5 on 10. And I'm curious if any of our guests want to comment on that. And I'll start with Natasha to allow not put Igor, Taylor, or Ben on the spot in case they want to dodge that question.
I would say I'm seeing the same, but I also am interested in what the investors are saying or what they're willing to give up on this question.
I mean,
Igor, do you want to take that? Or sorry, Ben, go ahead.
Well,
Go ahead.
I mean, just high level for us. I mean, we're investing very early stage. You know, our check sizes are typically 200 upwards of 750K. So not big checks, but you know, again, we want to get in really early. And we like to be, I mean, sub 10 million valuations, and even if it's really early, sub $5 million valuations. But that's, you know, we'll look above that, and we've invested above that as well. I mean, it really depends on the opportunity, of course.
Yeah, I would say same. I mean, our check sizes kind of first check-in is can be anywhere between $500,000 to $2 million, and we aim to get, you know, kind of low double digits, you know, high single digits type of ownership. And kind of you can do the math from that.
Taylor?
Yeah, I think fair is ultimately what you negotiate with the founders, and their pedigree and the heat on the deal probably plays a big part as well. But I think it's probably a little lower than 10 just because revenue multiples in the public markets have dropped so significantly that when you work with a founder and back into a deal, it has to be a win-win. That if you're going to roll your sleeves up and work side by side with the founders, you know, even if they crush it, there needs to be an up round to bring momentum into the company, keep the employees happy, keep the founders super enthused. And so you kind of got to show the narrative and help them understand like the step-by-step process.
If I could jump in here, I would love, Taylor, if you could comment, and love the other investors to comment as well about how you see the seed market and how you position your fund within it, and how taking a check from your fund is different than taking a check from another fund. And just to kind of position, you know, I think our founders probably have heard of big name funds which have big platform services teams, and who advertise, you know, that they have lawyers on staff and engineers and marketing people and recruiting people. And you know, obviously seed funds like the companies you invest in are lean and mean. So I'd love to hear from you, Taylor, about how Tenacity helps its portfolio companies from the moment you invest.
Yeah, I'd say we are hyper focused on helping our founders on the sales side. So we have a deep corporate network. And so we, you know, I think for more than 75% of our portfolio companies, we've made curated introductions that have led to sales. And then I think where we shine is we have over 40 Series A and beyond venture investors as LPs in our fund. And so we are hyper focused on helping our founders raise their Series A's and helping them, you know, constant monthly meetings, getting ready for the Series A, going through deck doctors and rehearsing out that partner meeting pitch. So like at the end of last year, we had invested in 15 companies so far out of Fund 1. 12 of them had raised rounds at least double the valuation where we entered from our introductions of the 15. And so we like to think that, you know, helping with fundraising is one of the most impactful ways we can help these operators.
That's awesome, Taylor. Igor?
Yeah, the reason we started Cortical was actually to try to build a venture firm that at our previous company, Data Robot, we had all kinds of investors. We've raised $1 billion from, you know, who is who of Silicon Valley, all the top names you would know. And they all were great people. I should say most of them were great people. But they really didn't have the domain expertise or experience of building companies that to really be helpful, despite the best intentions. And that's really the firm we wanted to build. And the reason people take our money versus anybody else's money is because they appreciate kind of deep domain experience in AI, that we can have a deep conversation on this stuff, not just conversation based on the last blog I read or thing I saw on Twitter last night, but have a real meaningful, deep conversation about the product and tech and space. And also, having experience of building and scaling companies, I think also brings the level of depth and empathy and all this other stuff associated with building a founders that I think founders generally appreciate at this very early stage. So yeah, we don't advertise it like you take our money and we get you like 10 customers or something. That's not what we, even though we try to do that, but that's not. We advertise that we can sit down and have a real conversation about a company building. All aspects of it in the case that many investors probably can.
Thanks, Igor.
I mean, I think for us, one differentiator is Shukshin and I are both technologists by background, so we, can have real conversations about the technology and what the potential is. One of the strategies we're attracted to as a fund and we look for is helping companies get early stage sort of proof of concept or non-recurring engineering revenue to kind of fund early development and reduce reduce burn and dilution for all of us, including us as early investors, them as founders. So to that, we pride ourselves on making intros to anyone. If you want to get into anyone, we will find a way to get there. If we know them, great. If we don't, we'll find out how we can get them in there. Lastly, for me personally, what I find I resonate with is I can talk about being an early stage founder and having gone through the fundraising and the early customer discovery and all of that stuff, and really help kind of the psychology part of being an early stage first time entrepreneur, or even if you're doing it for your second or third time. And I think I add a lot of value there just by being someone who's been in the trenches.
That's awesome. Brett, feel free to interrupt me, but I was going to follow up with a question about location. Ben, you're in Boston. Igor, you're in Silicon Valley most of the time. Taylor, you're a Silicon Valley guy or a San Francisco guy. We learned in the pandemic that we could all work remotely, and I imagine that you may have invested further afoot than you might have previously. And I'm wondering whether location matters. Ben?
Well, technically, we were an East Coast fund. It was part of our thesis. So far, we're not really hitting that part of our thesis. Most of the rest of the thesis, we are. We've got 3 California companies, a UK company, and a Boston one. I will say that we've had 2 Silicon Valley investments that one moved to Boston and one's moving to Austin. So, I mean, I do think there's some this price point of living and hiring people in Silicon Valley. I mean, it's always been true. It's always been high, but I think entrepreneurs are rethinking it. And I think, I love the Valley. I'm not trying to be anti-Valley here. I think the price point of living there and being there is just so high and hard now. It's people are reconsidering other options because of the COVID and the remote. What remote opened up.
Igor, what do you say? What do you think?
Yeah, we don't have any kind of thesis or constraints or belief in one geography or the other. We've been completely flexible. We have a portfolio of 14 companies. 2 of them are based in Europe, or whatever that means, because I don't even know what that means, to be honest. What does it mean they're based in Europe? So the founders happen to live in Europe. The company is in Delaware. The team is everywhere. So I guess founders are in Europe. I don't know if the company is in Europe. And so I think the whole concept is pretty loose this day and age. That it's really hard to even figure out where the company is based, quote unquote.
I think that what Igor just said is one of the things that's changed the most in my time in Silicon Valley is that it used to be if you met with an investor and you said that your CTO was in Poland and your CMO was in Spain and your engineering team was in Bulgaria, that would be like this huge red flag for investors. It really make them really nervous. And now that's kind of become a fairly common scenario that you're incorporated in Delaware and you've got this dispersed team. It's fascinating to me how that's, COVID was obviously a forcing function for this, but it was even beginning to happen before COVID.
Taylor, how about at Tenacity?
Yeah, I think it's just allowed us to see more virtual demo days. And so I echo Igor's and Ben's points that location doesn't matter as much. People are much happier in larger spaces, it seems like. So, still the Valley is still extremely important. You think you have to come to the Valley to fundraise, but to actually run the operations and day-to-day of your businesses, you can go elsewhere. I think the one interesting point though is I think the Valley still, when you have pre-seed and angel investors that aren't from the Valley, they're very scared about losing all, like the thought of losing all their money in an angel investment compared to the thought of 1000xing. I think that's where there's some differences still between the Valley and other parts of the country.
So that we're worried about the downside than excited about the upside.
Right.
I was going to say one nuance is here. We do distinguish between distributed and remote. It's actually not the same thing, you know?
Right.
And so we do have some stronger feelings around being remote versus not remote. It's okay being distributed. You can have offices, you know, people concentrated across all over the place. But we do like to have like people concentrated in. It could be multiple places, but some concentration versus just hanging out on the beach somewhere and coding every now and then.
That's a good distinction. Yeah, that's a good distinction. Igor. Okay, so last question for you all. So most of you have mentioned that you see just tremendous opportunity today, which I agree with. I always, you know, I tell my students at Stanford that I've been in Silicon Valley for a long time. I've been through several waves of opportunity. And honestly, I think there's more opportunity today than I've ever seen in my entire career. Because it's not just one thing, right? It's, you know, it's, in other words, we had the semiconductor wave, and then we had the personal computer wave, and then we had the mobile social wave, right? But right now you got 5 or 6 or 7 different billion-dollar waves going on, right? So I think it's a very exciting time. But maybe we could just, as a final exercise here, just kind of quickly go around the room about, as you guys sit here in 2023 and look ahead, you know, what do you see that you're particularly excited about? Natasha, we'll start with you, because you're not an investor. But what excites you? What excites you looking out?
What we can do with AI and machine learning. I think that's really to see how it can apply to different industries and how it can apply to just better a lot of things that we're doing. That's what I'm excited to see.
Yeah. Agreed. Igor, what do you see going on that excites you?
You guys have to say crypto or something. No. Yeah, no, we are, you know, like I mentioned earlier, an AI investor. So we very much excited about AI over the middle to long term. We are a little worried that people's expectations are a little overdone in the short term. Demos are just so cool and impressive that it's hard to like resist it. But there's a big road to travel between a demo on Twitter and like real company deploying it in real environment and getting real production value out of it. And I'm worried that in the short term, people may be a little disappointed versus the expectations.
Right.
But super excited over the long term potential and like what's going to get built over the long term.
Taylor, what do you and your partner get excited about right now?
Yeah, I'll take a different spin on the question. I think I'm most excited about working with our founders each and every day within the portfolio. Like, I love every one of our founders. We talk to them weekly. And so, you know, we're starting to see some of these companies really reach that inflection point. And so getting to work with them and see the vision, you know, start to come to reality is for me the most exciting part.
Awesome.
That I'm most excited about.
And Ben, from your vantage point in Boston.
Yeah, I mean, what I think is incredible right now is this sort of intersection of software, hardware, and biology. And I think there's just, you know, I came from a digital health and digital biology background. I'm very bullish on what we're going to do in terms of solving healthcare and illnesses in a lot of ways. I'm also super excited just being now investing in deep tech, seeing what's being done on the climate side. I was pretty pessimistic before getting into this realm, and now I'm feeling a lot more optimistic that, you know, really smart people are working on really hard problems. I'm glad we're spending less time figuring out how to get people to click on stuff. You know, I like smart people working on problems that we really need solved in the world. So you know, I'm really optimistic about, you know, the earth and actually human health in lots of ways. And I just think there's incredible opportunities there.
Agreed.
If I were to give one, I guess I'm super excited about fire tech and water tech moving forward. I've met like 6 or 7 companies this year that have just been incredible in fire tech. I think, you know, New York City had a 500 plus AQI last week, which is pretty unbelievable. And, you know, there's really no budget to put a fire out. And so There's also not that many companies quite yet, but I think you're starting to see a lot more people take notice to these natural disasters and ways. Fires are one of the ones that can be maybe disrupted with some new inventions.
And you could probably put that under the larger umbrella of climate tech, right, Taylor?
Yeah.
Part of climate resilience, I think, is dealing with fires, right?
We have a great company in that space. I think it's a very exciting space as well.
Awesome. All right, Louis, take us home.
Well, I just wanted to echo what I heard, and as I get older, I just get more excited about the ability I have to meet new founders. And the more I do this, the more I know, and the more I know, the more I can share. And together with my partner Natasha Allen, we are serving just an awesome group of early stage companies and early stage investors. And it's been really great to have the three of you on here. I guess in wrapping up, it would be great if you could just share the best way to get in touch with you and reach out, as you're all very busy and you all have your own methods of being contacted, whether it's in the chat or if you wanted to make a comment about the best way to get in touch. I think that'd be great. And for me, Natasha and I have a website called foleyignite.com where we've got free forms, the answers to most early stage and startup questions that you'll find, and of course all of our contact details.
Nice. Ben?
Sure. First off, thank you for having us, and I'll give kudos to Louis and the team over at Foley. They're great, and we use them in different ways, and I've seen them work, and they really know their stuff. So thank you for having us. Wait, what was the question again?
How to get in touch with you, Ben, and when and why?
Oh, yeah. So best way to get in touch with me, email ben@skyriverventures.com. Also LinkedIn anytime. Just you can find me, Benjamin Haywood, Sky River. We love connecting early. Even if you don't have a pitch, just love talking about what you're working on. So early and anytime.
Great. Taylor?
Yeah, I'd say either LinkedIn or emailing me, taylor@tenacity.fund. Two best ways to get in front of me.
And Igor?
Yeah, I second what Ben said about Louis and Natasha and the team. And advice is, if you guys don't hire them to do your thing, then we'll hire them to do our thing. And you're much better off having them on your side versus our side. Just saying. But in terms of getting in touch, yeah, LinkedIn or Igor, IGOR at cortical.vc.
Nice. Well, thank you, panelists, for giving us your time today. And thanks to the audience for joining us. So throughout the summer, we'll be doing these Wednesday live stream panel discussions on a variety of topics. And as Louis mentioned earlier, next week we'll be doing AI and generative tech, which is the hot thing right now. So next week, we've got 4 terrific panelists to talk about AI and everything going on in that world. So thanks to all of you in the audience for joining us, and thanks again to the panelists. See you guys soon.